Okay, everybody, it's now time to move on to our next session. それでは続いてはこちらのセッションです。リキッドステーキングの未来 The Future of Liquid Staking. So let me introduce our speakers. ここでご登壇者をですね、ご紹介させていただきましょう。Master of Protocol Relations at Lido DAO, Mr. Marin Tvrdic. Head of APAC at Kiln, Colin Verhaegen. CEO and co-founder of Figment, Mr. Lorien Gabel. And founder of Nethermind and Twinstake, Tomasz Stanczak. 皆様大きな拍手でお迎えください。Let's welcome them to the stage. どうぞ。Okay, so Thomas, I believe you're the moderator for this one. So if you're ready to go, I'll hand it over to you.
Is it? Yeah, now it's enabled. Hi, welcome everyone. Thank you for coming to listen to us. And maybe we'll start with introduction. So, founder of Nethermind, Twinstake. So these are core engineering and institutional staking businesses, respectively. But let's focus on our guests more. So let's start with Lorien, please.
Pleasure to meet you all. Thank you for spending your valuable time listening to Liquid Staking. I'm Lorien Gabel. I'm one of the three co-founders of Figment. We're a Canadian-based company. I think we're probably the largest independent staking provider at this point. It's about $13 or $14 billion in assets under staking management. We do just staking, and we have just an institutional focus. So that means our customers are broken down into two segments, asset managers, venture capitalists, and the like, and then our distribution partners, wallets, custodians, exchanges. And look forward to talking about Liquid Staking with you all.
Good, thank you. Colin?
Konnichiwa, everyone. Nice to be here in front of you guys. I'm head of APAC for Kiln, staking as a service company, and we exclusively partner and help custodians, wallets, exchanges, banks, telcos with their staking needs and simplify how they bring that to their end clients, whether that's retail or institutional.
Thank you so much. And Marin?
Hi, everyone. I'm Marin, Master of Protocol Relations, contributing to the Lido DAO. Lido DAO is an organization that consists out of node operators, out of researchers, out of contributors to the middleware. So it's very important to distinguish that the DAO is just one side. The other side is this phenomenal software that connects two types of users, node operators and stakers. So it's a fully self-custodial automated software where it transfers user stake to the node operators who secure the network, the Ethereum itself with it. Meanwhile, it mints digital representation of the staked assets, which we called a liquid token. With the liquid token itself and the whole ecosystem, we will deep dive further in our panel.
Yeah, Marin, actually, maybe take advantage that we're with you talking now. So if you maybe can explain a bit more in details of like the story and also the direction of liquid staking tokens. It did start with Lido, and now it's evolving.
Sure. So to fully understand liquid staking, we first need to take a step back and think of Ethereum as proof of work chain, where you needed to have miners to generate new tokens as rewards for closing the blocks. But then there was a great engineering feat of creating Ethereum, transferring it. I think it's the first blockchain in existence that actually made this transfer from proof of work to proof of stake. What does that mean? It means now you need to, instead of having a hardware that's competing against each other, consensus changed to a setup where you deposit specific amount of Ethereum to the nodes, which then validate on the network. If they validate successfully, they get rewarded with Ethereum, same as they were rewarded in proof of work. Now, with this in mind, it enables us a specific new asset class. Because previously you didn't have use case of Ethereum in these terms because you didn't need to stake it. You just had to have mining hardware. Now you stake it and you lose ability to interact with the asset. So you lose the ability to trade, to deposit it as a collateral, to participate in the minting of NFTs or anything essentially what you can do with ETH, even pay gas. So it's gone. Not gone, but it's deposited, it's secure in the network, you receive the rewards, but you can't move it, and there's the difficulty. If you want it back, it can take some time, depending on the congestion of the network. It can take up to 1 day, up to 5 days, maybe more, depending how many withdrawals are requested. That enabled us to create a very unique asset, which represents the ETH that's deposited to secure the network, and still use it, provide liquidity. So in terms, it became equal to Ethereum, because today you can even pay for gas with it.
Thank you. Fantastic explanation. Would you like to
I was
add
just saying
something?
my favorite analogy for what a liquid staking token is like the movie Die Hard with treasurer, but with bearer bonds. So it's a direct representation of instead of the US dollar, of the staked ETH. So it's a fun way to think about it.
Great. And talking about the future, actually, and maybe also the user experience around liquid tokens. Colin, you mentioned you work lots with various partners with different approach to staking. You try to present the product. What do you see being the most important for adoption, for user experience, for growth of the usage?
Yeah, it's a good question. It's a difficult one as well. So maybe to put things into perspective, right? So when it comes to staking, there's different forms or types, right? So it goes from the simplest form, which typically we call native staking, right? Then you have versions such as liquid staking. Now you have restaking as well. So everything becomes a bit of a spectrum, right? From native to a bit more complex, either technically more complex or financially more complex. And that's like the spectrum we see. And then there's also different forms, right? You have dedicated staking, pooled staking. So there's a lot of combinations you can think of. And on that spectrum, we see clients of ours, or in general, landing somewhere, right? Depending on their use case. So for an exchange or a retail wallet, typically those users, they're more rewards or yield chasing, right? So they look at where can I get the highest APR, right? So maybe they do liquid staking, and then with that token they go into DeFi, and then kind of they scale the rewards, but they also scale the risks. On the other side of the spectrum, you might have institutions, right? Banks, telcos, custodians, asset managers, a bit more risk averse, and these typically prefer native staking, right? Because then they reduce risk, also reduce APR, but that's like where their level of comfort sits. And so adoption is different for these different market segments and how they want to present the rewards and the risks to their end users. Like, for example, at Kiln, we have solutions to map all of these use cases. And so the adoption really comes from how simple is it to deposit, to withdraw, what are the risks involved, right? Smart contract involvement or not. And especially the front end seems to be a very big differentiating factor. Not that we as more likely like Lorien and Kiln, like Figment and Kiln, we don't play that much of a front-end game. I think that's more on the Lido front, but we try to enable that with technology, right? And so the better the UX in the front end is, the more adoption we see. Hence why Lido has been so successful, right? Easy front end, 2 clicks, stake, deposit. You get the synthetic token in return. You can deposit in DeFi. I would say the UX on the institutional front is still in development, but we're seeing institutions that are starting to figure that out as well, how to distribute these type of products, whether they do that through more TradFi routes, think about, wrapping it in ETF and other structured products, or whether that's like enhancing their platforms such as easy custody, easy click, point, stake. These are the things that will enhance UX and adoption for staking through the whole spectrum, in my opinion.
And I think there's also significant regulatory barrier, at least in certain markets like North America. So, for example, the ETH ETFs, which have recently been approved, don't have staking yet approved. That'll happen, but I think we're still a while away before you see at least TradFi institutions consider liquid staking. It's just there's still, for the non-crypto native institutions, there's still a fair amount of confusion still on the regulatory front around staking itself. Even like whether staking is a security, whether it's custodial, there's some really basic fundamental questions that still have to be answered. And so I think liquid staking is probably like 12 to 24 months away for a lot of those institutions, at least that come from the TradFi side.
Yeah, great. I mean, you have lots of insights into the institutional market. Obviously, that's where you focus. When you think about the definitions of who you see the institutions are, who they are not, and what are the other specifics that really differentiate that market, the institutional market, the approach to that market, their unique challenges when you analyze it?
Yeah, sure. So, slow and cautious. They obviously have many more considerations than crypto native firms. So with your question, I assume they're coming from the traditional finance side. And so I think primarily, again, a lot of the issues are around safety and around regulation. And so, I think there's been concerns about Lido and its concentration risk. I think the reality is that hasn't shown up. Like the reality over the last 3 years or something has been that there isn't. But there are still concerns like around governance and upgradability and things like that. Again, I think the Lido's like proven itself that it's those concentration risks don't exist to date. But I think there's still some questions to be answered, which we were talking about behind stage around governance. And once those are resolved, I think that'll help also.
That's great. So, Marin.
I would love to just circle back to the previous points Colin was mentioning. So contributors of Lido understood this problem very early and jumped to it by enabling institutions to natively mint through their favorite custodian. So the tooling, the software, they're familiar with the Web2 experience. The point is to be very accessible, and that's a key for success of a liquid stake token. It's not only liquidity, it's accessibility itself. So yeah, concentration risk, I mean, there was a lot of back and forth until more riskier thing came along, which is restaking. Now no one is talking about risks around Lido, it's more concentrated around the eigenlayer. But still, Lido at its core is built with focus on decentralization, which translates to more secure. Why? There's no single entity and there's no single person controlling your stake. It's a soft cap around 1% per node operator, and currently there's 180 node operators contributing to the Lido protocol. But 37 in the curated set are the most branded, the industry standard setters, which is very, very important and the backbone of all of this. In terms of governance, yes, contributors again recognize this problem very early, but once you have a $25 billion protocol, it's not very easy to do changes ad hoc, and without deep research, heavy development, testing, auditing, QA, full stack like a traditional entities have, and then push it to production. So the resolution for the governance is a thing called dual governance, meaning token holders, the voters, and stakers do not necessarily need to be the same entity or a same person. So with the dual governance, there's a chance for the stakers, if they're not aligned with the changes being done to the protocol by the token voters, they can veto the proposal, and it gives them opportunity to leave before the actual proposal, if it gets voted in, gets through to the blockchain. But the beauty of all of this, it's permissionless. So you don't need a permission from any of us to interact with these smart contracts. It's all on the Ethereum blockchain. So you can start participating in the governance just by getting the tokens and voting. It's an Aragon-based DAO, or when you're a builder, you can do direct native integrations or your own front end. So you're by no means bound to a group of us here.
Okay, and maybe Colin, starting with you and then with Lorien. So the restaking coming in, AVSs, how do you see the approach where you actually see the customers asking about this? Are they interested? Are they afraid? Is it like cautious and slow, how Lorien mentioned? Who is interested in restaking? What do you think the evolution of this market will look like?
Yeah, so I'll try to answer that one, and coming back to the last one. So I think from an institutional perspective, right, the success of staking, liquid staking, restaking is going to be very dependent on regulations, right? And so we have discussions with regulators all around the world, from Japan, Hong Kong, Singapore, to Switzerland, Germany, France, the US. And the big hurdle is still education, right? Sometimes regulators don't even know or don't even try to know the difference between lending and borrowing and staking, liquid staking, restaking. So in my opinion, we're still far away from TradFi and regulators fully embracing this. So I think we're not even like seeing the first big wave, and there's a way bigger tsunami coming, let's say, when the real institutions and the regulators start to understand and hopefully unblock many of the restrictions or fear they might have, right, when it comes to staking. And then coming back to restaking, right, restaking is the easy way to put restaking into perspective is you have staking, which is native consensus on the blockchain for proof of stake network. I would probably categorize then liquid staking more as like a financial revolution to staking, right? Adding the liquidity, adding the financial blocks and constructions that you could add certain layers for more rewards and more financial operations. And then restaking, I would categorize this as a technological revolution to staking, making it easier for projects and protocols to not spin up their own, but basically come and lean on a protocol like Ethereum, right, to launch their project and protocol without going through the hurdles of building it from scratch. So fundamentally, they're very different. What they do have in common, I would say, when it comes to liquid staking and restaking, is that they typically attract, at least from a user or holder perspective, people, retail, institutions, a little bit less, but the ones that are more okay with risk and also chase more rewards, right? So we call them, airdrop or point farmers. We call them yield chasers. So these are the ones that currently we see are the most interested in restaking, right, with the current platforms, and those that are already jumping headfirst into that. Institutions, definitely not so much.
That's right. I think it's mostly been a degen phenomenon, and I think it still remains to be seen with restaking whether security is actually the reason there aren't end-user applications. I think like it solves the supply side if that's a problem, but I still don't see the demand, and we'll have to see which AVSs matter or are actually creating utility at all. So I think it's a wait and see. I'm a little bit skeptical that any of them will actually be doing anything, and that there isn't really a problem with a shortage of security for new projects. I've never heard, we also have a VC fund. I don't think I've ever heard an app fail because there wasn't enough security for them in some way, but we'll see.
So then if not restaking, then what would be the innovation in the institutional world? Like what people are looking for in the next 2-3 years for the staking products for institutions?
I mean, it's very, very clear for institutions. It's similar thing what even retail users want. They want the highest possible APR, right? But the nuance is they want it really, really safe, where the retail user will go into something very, very risky, probably not aware of what they're doing. Institutions are very, as already mentioned, cautious with this. But I don't see restaking as going away. I think it's a really, really nice innovation that happened in the staking space recently. The problem of it's kind of got rushed out to the market, and then we had a lot of buzzwords like native restaking. Like, there's not really many ways how to actually stake Ethereum, and so there's no native restaking. It's all staked the same way. how it's used after, that's the difference. So there's a new set of smart contracts, there's a new set of software that allows you to share the security of the Ethereum. Now, I still don't believe that they will change the landscape of the staking itself, but I believe they will innovate, because now you can use any collateral to pay for security, like to be secure, not to pay for security. So, but I still think liquid stake tokens are the best collateral out there, because they're accruing rewards while you passively hold them. So as an AVS, it makes sense to accept STETH as a collateral. As a user, if you want to restake, it makes sense to actually restake STETH, for example, or any other liquid stake token that's out there, to not kind of marry the microphone here.
And Lorien, do you think that there are different expectations in different regions about the direction? So is the regulatory pace different when you come to APAC versus US, Europe? How do you see institutions approaching it?
Yeah, I mean, so obviously in our home market in North America, the regulators have been, for the at least, you know, in 30 years that I've been doing infrastructure, internet startups, is behind the rest of the world. I say this a lot, but you know, Winston Churchill said the Americans will do the right thing after they've tried everything else. We're kind of at the end of the everything else stage, I hope. So we'll see come November after the election. So I'm cautiously optimistic that we're over the worst of it, no matter actually who wins in the election. I think there'll be a change of regime somewhat. So on that side. But in general, just sort of taking a step back, I'd still really like to see, I think we've solved the problem around liquidity of staked assets, et cetera, by Lido. I think it's a solved problem right now. I'd really like to stop focusing on, I don't know, inside baseball and more derivative instruments. I don't use the word derivative in like an actual derivative, but I'd really like to see end user pull outside of, you know, I mean, to be honest, you know, basically at this point, Ethereum is the payment rails for USDC and a few other things. And so that's the reality. At the end of the day, the yield has to be generated from value creation and end user pull, because otherwise it doesn't really exist. And so, you know, I'm really focused at this point. I think we've solved some of the problems with staking and the financialization of that asset. I'd really like to see some end user adoption now that's pulling and creating value outside of like token creation, basically. So.
Thank you. And talking also about the innovation evolution of the market. So recently we have movements in bringing DeFi rollups, staking to Bitcoin. Maybe if any of you would like to start with the comments on any of the Bitcoin markets.
Well, certainly, you know, I'm on a panel tonight at 8 p.m. with the Babylon team, and I think it probably represents a significant market expansion for our companies, if it actually works. Again, you know, in a weird sort of way, I think that liquid staking should have come to, leaving aside the Bitcoin maximalists who think nothing should change with Bitcoin, which there's a significant amount of people, but in some ways, since Bitcoin's obviously or most obviously a financial asset at this point, I'm surprised that some version of liquid staking didn't actually, or yield outside of lending didn't come to Bitcoin first, because you would think it would make more sense with Bitcoin as a, you know, a more obvious financial asset, where you know, Ethereum is more of a open computer network or protocol. So it's kind of been reversed. So I think it actually makes sense, leaving aside the sort of the nature that Bitcoin shouldn't change at all. I think it actually makes more sense for Bitcoin than Ethereum in some weird, odd sort of way. So I'm, again, cautiously optimistic, but again, at the end of the day, it's like, where does that yield come from?
Yep. So that's actually a good call out. So we go back to the beginning of the panel. Bitcoin is proof of work. So essentially, there's no way to generate those rewards and to pack them into
outside of lending, basically, with co-party risk. Right.
But that's why I think liquid staking has future, because it's polyvalent. In this case, for example, Bitcoin is coming to Ethereum. You can see the layer 2s actually being EVM compatible. What does that mean? That means they can utilize Ethereum's assets. They can be traded on Ethereum. And so what happens with our liquid stake tokens, they become a primitive. So in this lack of user adoption and user-generated yield, they can benefit from rewards of securing Ethereum. So as a base principle, you get essentially 3% of Ethereum's emissions as an underlying asset. So what we will see is a lot of these liquid stake Bitcoin projects actually having delta neutral strategies based on liquid stake tokens.
Yeah, I agree with both guys here. And personally, I'm also very excited about this, but also cautious, right? Because again, it's your typical, risk-reward type of story, right? You have a new layer, you have bridges, you have things that are extra surface for hacks and exploits, and so everything will depend on how secure and how positively this goes. I mean, Babylon launched earlier this week, or was it last week? They filled the cap immediately. It was not a massive cap, but it does show the enthusiasm for it. So fingers crossed nothing happens, and then this becomes like a new playing field for everyone holding Bitcoin. But it's also interesting because it enables more and more things that are actually transposed from Ethereum, right, with the EVM type of thing. So DeFi on Bitcoin, and it opens up new opportunities. But yeah, we have to remain very cautious of not overdoing it and not going head over heels. I think especially the institutions for this, and let us try this out at smaller scale and prove that it's worthwhile doing. And like Lorien said, the yield has to come from somewhere, right? And that somewhere has to be an application and something that users like and want, right? And that could come from many places, right? From telco use cases, media use cases, financial use cases, but they have to be built. And that's I think the biggest risk or the biggest hurdle to overcome is we need builders to come and create that thing, because without activity there's no yield and there's no use for this, and it's probably more risk than it is reward if there's no activity being generated.
When you think about the challenges of setting up the infrastructure nowadays, I think it must have evolved over the last years. People built some standard approach, templates, approaches to security. So technically, to deliver the infrastructure that provides security, that provides great efficiency with the constant decrease of cost to be able to capture some of that yield as an operator, there's lots of technical challenges. How would you describe, when you look at your teams, those technical challenges affecting the future of staking? What are the current biggest challenges in the infrastructure space?
I think it's fair to say it's getting much more complicated. I mean, Ethereum staking at scale is a thing that's fairly unique. There's a big difference between running 5 or 10 nodes and running tens of thousands of nodes at scale for customers. Around process and security, et cetera. And I think adding on the layers, for restaking, the AVSs are essentially, each one's a new blockchain. So as an operator, if you have to add a whole bunch of AVSs, is very resource constraining, or it takes up a lot of resources. And things like Babylon are actually pretty complicated also. So I think things are only getting more complicated from an operator perspective, and things like Solana look relatively simple by comparison.
Yeah, 100% agree. And it's you have this different times, right? Like we were in more of a bearish market, like the past maybe 2 years or so, which made it easy because you could focus on building, optimizing, automating, and that's like good, right? And that's like where we as Kiln also took the time to kind of build everything at scale. And so now we're ready for this bull sentiment. But the bull sentiment brings also a lot of bells and whistles, and there's a lot of noise, right? Which protocol to support first, and how do we do this? So it's a constant internal struggle to be like, okay, is it going to be protocol A or B that we're going to support, because we're restrained in resources, either technical or people resources. So the struggle is not always technical, but really just also human, right? Understanding the opportunity, understanding the use cases, and then prioritizing them based on sometimes the limited market information you have up front.
Yep. We have a question.
Hi. Sorry to interrupt. I'm not sure if questions are allowed here, but you briefly touched on how staking is getting more complicated. Could you expand on how?
Yeah, so just as you know, certainly as more institutions come into this space, their requirements are significant just from a business operations perspective. Various certifications, security, reporting, UX, etc. But with liquid restaking per se isn't that complicated, but restaking is complicated. There's a whole other technical layer. And again, some of the liquid restaking protocols have multiple AVSs, and essentially AVS is a new blockchain. And so every time you implement a new blockchain from a provider perspective, it adds a layer of complexity. So there's, I don't know, 15 or 20 AVSs out there now that'll be launching shortly, and each one is essentially a new blockchain. So that's slightly different. So as an operator, that just takes a lot of resources, again, from people and capital, et cetera, to support those chains, especially if it's an institutional audience, because you have a whole set of requirements around that. And then just the nature of bridges from, when we're talking about Bitcoin staking, that's another layer of complexity about how you manage, depending on the model, about how you manage that. And so that's a whole another thing dealing with Bitcoin, which most of the staking providers haven't done before. So there's just an added level of complexity beyond like delegated proof of stake like Solana, which is basically one node can take as much stake as you want. Ethereum was another level, 32 per node. So now if you have a couple $1 billion of Ethereum, we're running tens of thousands of nodes, and then the complexity keeps on layering up on top of that.
Thank you. Thank you so much. We cannot thank you for the questions, and thank you a lot for all the insights and comments.
All right.
We have to finish here, yes?
Yeah, it looks like we're running a little bit over time, but thank you very much for the wonderful session. ありがとうございました。皆様拍手お願いします。Okay. Before you leave the stage, you want to get a quick picture of you four gentlemen together. See if you can kind of gather at the center of the stage. これでちょっと4名の写真を撮らせていただきます。All right. Thank you very much. 皆様改めて拍手どうぞ。Thank you very much. Okay, so we'll be moving on to our next talk session in just a moment. Have a quick set change to make. Shouldn't take but more than a minute or two, and then we'll be ready to go in just a moment. この後間もなく次のセッションに参ります。その前にですね、簡単なセットの転換をさせていただきます。しばらくお待ちください。